Many people think that investing is tough because in their minds, it means spending hours doing deep research to find the best companies, constantly tracking market news, timing the perfect moment to buy before a big run-up, selling right at the peak, while avoiding all the crashes in between. But what if I told you that investing doesn't have to be like that? Instead, it is much simpler than you might think. Because the truth is, investing is already a solved problem. Through decades of data and countless research, experts have figured out what works in the long run. And it's not about stock picking, market timing, or chasing the next hot trend. So in this video, I will break down what the research says and share a simple strategy that can help you grow your money with way less stress and a relatively high degree of confidence, even if you are just getting started. But before that, I think we need to first answer one important question. Why do we even need to invest at all? Why do we need to take on all the extra risks and can't just rely on plain old hard work to grow our wealth? And the answer lies in this note, or rather, the value of these notes during different time periods. If we just rewind time to just 10 years ago, a plate of chicken rice in Singapore used to cost just $3. Today, it has gone up to over $4. Likewise, a McSpicy set meal would cost just $6.40, but now it is over $8. Yes, you could argue that all this were caused by greedy businesses looking to squeeze out more profit from you. But regardless of the reason, one thing is clear, the purchasing power of your money has gone down over time. The long-term inflation in Singapore has averaged at around 2%. So assuming you have worked hard your entire life and amassed $1 million in your Milo tin, or in my case, my child's milk tin, because that's the only tin I can find around here, over the course of 25 years, the purchasing power of this money would have gone down to $600,000. Or to put it simply, 40% of your hard work, stress, and late night crying in office is gone. Just like that. This trend has gone on for a very long time, and it is safe to say that inflation and greedy businessmen aren't going to go anywhere anytime soon. Now, maybe you are smart. You don't leave your money sitting in a Milo tin or milk tin. Instead, you park it in a high-yield savings account or government bonds, earning around 2 to 3% returns. That might sound decent, but it only puts you slightly above Singapore's long-term inflation rates, meaning you are just barely keeping pace and not really getting ahead. Quick pause. In celebration of SG60 and Usmart's first branch opening in Singapore, Usmart is offering 12% interest on our selected money market funds for 60 days, valid until 31st August 2025. This promo is available to both new and existing users. To enjoy this promo, just deposit $2,000 during the campaign period, head over to the Wealth Plus tab, tap on Money Market Fund, select the fund, subscribe with the full $2,000 amount, hit submit, and you are done. But wait, that's not all. Usmart also offers zero fees when you set up a regular savings plan into eligible Singapore and US stocks and ETFs. And if you are new to Usmart, you can sign up today to receive up to $202 worth of welcome gifts, including share vouchers, cash vouchers, and free live market pricing for both US and Singapore markets. So sign up for Usmart SG using my link below to enjoy these exclusive offers. Now, let's get back to the video. However, even the inflation number may be a little misleading, because the truth is, the cost for 3 of your biggest expenses, housing, food, and healthcare, have all gone up by more than just 3% over the past several years. So by parking your money in a high-yield savings account, not only you are barely keeping pace with inflation, your money is still losing value even after earning that juicy 2 to 3% interest. Because of that, for the money that you are planning to hold long-term, you need to find a way for it to outrun inflation. And one way you can do that is by investing. Over the long term, the US stock market has delivered an average return of around 10%, or 6.5% real return when we account for inflation. This far outpaces the average inflation rates of Singapore and even the US. However, there's one very big fine print, and that is, for it to achieve this average return, you need to stay invested for at least 10 to 15 years. Anything less than that, you will have a good chance of losing money. Now, of course, I'm not saying that if you invest your money, you will definitely get that kind of return, because past performance doesn't guarantee future return ma. Because as long as you don't do anything with your money, inflation is going to eat away at its purchasing power. So then, what should you invest in? Most beginner investors will just go for the top stocks, which at the moment are the Magnificent 7 stocks, such as Nvidia, Amazon, Meta, Apple, and so on. That sounds like a good strategy, right? After all, the Magnificent Seven stocks didn't get to where they are by mistake or by hype. There's real strong company earnings backing their performance. They are a dominant force in their industry, and they have wide moats that protect them against their competitors. If you look back to the early 2000s, Nokia was also one of the world's largest and most dominant tech companies. It was the poster child of mobile innovation, controlling over half of the global phone market at its peak, and was once the most valuable company in Europe. Back then, if someone had told you that Nokia would eventually become irrelevant in the smartphone space and get overtaken by companies like Apple and Samsung, which were barely players at the time, you would have probably laughed it off. But that's the thing about markets and the world. They evolve. Technologies change, consumer preferences shift, and companies that once seemed invincible can quickly lose relevance or be disrupted overnight. As the world moved rapidly into the smartphone era, Nokia, once the king of mobile, failed to adapt, lost its edge, and is now seen as a relic of the past. Okay, maybe going for just the top stocks isn't the best idea. How about we diversify a bit more and maybe focus on the tech sector instead? After all, tech has been the star performer over the past decade, and with the ongoing AI revolution, it seems like tech companies will continue their strong growth. In fact, tech is so dominant that it now accounts for nearly 1/3 of the entire US stock market. But if you rewind time all the way back to the year 1900, the US and the UK markets look completely different. What sector do you think was so dominating in the markets back then? It was rail. Railroads were the lifeblood of the economy, connecting cities, enabling trades, and fueling industrial expansion. They weren't just a sector, they were the backbone of entire nations. Again, if back then someone had told you that the railroad industry would fall out of favor, you would have probably laughed at them too. Today, tech is dominating the markets, just like railroads did back then. But just as history shows us time and time again, dominant sectors don't last forever. With global trends like aging populations, rising chronic diseases, and advances in medical technology, could it be that healthcare would become the next dominant industry? In a research paper titled "Do Stocks Outperform Treasury Bills?", it was found that the best performing 4% of listed companies explained the net gain for the entire US stock market since 1926. Companies come and go all the time. The average lifespan of a company in the S&P 500 is only 15 years. Focusing on any one company or sector can be risky because winners change over time, and by concentrating your bets, you might just miss out on the next big opportunity. Therefore, a more prudent approach is to just buy the entire market, because you won't buy the wrong stocks if you buy everything. The clever part about this strategy is that by simply investing in the entire market, you will automatically be investing in the top companies at any given time, the leading sectors, and even the rising stars, all without needing to be incredibly lucky or a stock picking expert. This is also why Warren Buffett once said that the best way to own common stocks is through an index fund. Those following this path are sure to beat the net results delivered by the great majority of investment professionals. And sure enough, over the long run, an overwhelming number of active funds underperform the market. The most popular index is of course the S&P 500. It hosts some of the largest and strongest companies, and over the years, it has delivered a strong return regardless of wars, pandemic, inflation, oil crisis, stagflation, or whatever nonsense you want to throw at it. However, the world is much larger than just the US, and US only accounts for close to 2/3 of the total investable markets. And much like the sectors and the companies that come and go, there's also a chance that the US markets might lose their dominance one day. For example, both the US markets and the international markets have taken turns outperforming each other, and it just so happens that the US market started to dominate in the 2010s, right after the Great Financial Crisis. If we go even further back to the 1900s, the most dominant stock market in the world wasn't the US, it was the UK, which accounted for about 25% of global market capitalization. Today, that share has shrunk to less than 4%. Then, in the 1970s and 1980s, it was Japan's turn to shine. Fueled by rapid industrialization, innovation, and global exports, Japan's stock market soared. At its peak in 1989, Japan made up nearly 45% of the global market. People genuinely believed Japan might overtake the US as the world's dominant economic power. But their dream faded after Japan's asset bubble burst in the early 1990s. Could the same happen to the US too? Honestly, I don't know. Personally, I remain optimistic about the future of the US as it continues to lead the world in innovation, entrepreneurship, and technological advancement. But if you are not so sure or simply want to play it safer, then a more prudent approach would be to invest in a global ETF, which gives you exposure to the top companies across the entire world. That way, no matter which company leads in the future, your investments will still do well. So now that you have an idea of what you can invest in, the next question is, when is the best time to invest? The S&P 500 has delivered an average return of 10% over the long run. But make no mistake, its annual performance is far from average. Over the last 100 years, there were only 6 years where the S&P 500 gave close to 10% returns. In most years, the markets either gave wildly higher returns or depressingly lower returns. Even so, looking at the annual return chart can be quite misleading because it hides the true picture of what is really happening within those years. Instead, this chart tells a much clearer picture. What it shows is that every year, no matter whether it ends in the green or red, the market has always experienced some sort of a drawdown in between. Take for example the year 2009. That was the year the S&P 500 hit the bottom of the 08-09 crash and went on to deliver a 23% return. However, during that same year, it also saw a huge 28% drawdown. In fact, drawdowns are so common that on average, the markets would usually experience a 5% drawdown every 2 times a year. Then every 18 months or so, we will see a 10% correction, and roughly every 3 years, a more significant drawdown of 15% or more tends to occur. Most people think that the challenge when it comes to investing is choosing what to invest in. That is actually the easy part. The biggest challenge is actually managing your own investments and learning to see past your bias. In trying to avoid market downturns and only invest during the good times, the average investor often ends up significantly underperforming the markets, sometimes barely beating inflation. That's why for most investors, the smartest approach is to simply aim for the average. Instead of chasing the highest performing stocks, you focus on capturing an average return through a diversified ETF, rather than trying to time the markets by investing only during the good times and avoiding the bad times. You consistently dollar cost average into the markets. By doing that regularly, year after year, you will end up with a return that's far from average. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.